Investors driving the strong start for stocks this year appear to be looking across the valley of softening fundamentals, such as falling U.S. corporate earnings. Instead, we believe they're focusing on declining inflation, the near completion of central bank rate increases, and moderating long-term interest rates. We think investors have appropriately priced in economic resilience, supporting our neutral stance on developed market equities. Let's take a closer look. Notably, the Federal Reserve hasn't pushed back on falling long-term interest rates and rising stock prices, representing an easing of financial conditions. We think some feared the Fed would view more optimistic markets as impeding their ability to wrangle inflation, prompting a more hawkish posture. Investors receive well the lack of concern from Fed Chair Jerome Powell in comments last week. Still, we don't think that means the Fed is backing off more rate hikes. The U.S. added 500,000 jobs in January, more than double the forecasts, and unemployment fell to multi-decade lows. Further, the gap between the number of open jobs in the U.S. and those seeking employment has widened. We believe the Fed will primarily monitor how the ultra-tight job market will continue to increase wages, even as other contributors to inflation, such as goods and housing, have or likely will moderate. We think wage growth will lessen somewhat, but the unexpectedly durable job market makes the Fed more likely to follow its plan of 2 more 25 basis point rate hikes. We think investors will balance the favorable directional trend in inflation against sluggish fundamentals. Corporate profit expectations continue to come down, though we think the worst of the reductions in earnings estimates for this year has passed. We are incrementally less worried about the economic outlook in the U.S., aligning the region to our recently improved view toward non-U.S. markets. Continued strength in the U.S. labor market suggests resilient corporate sentiment and consumer conditions, while Europe's economy is benefiting from lower energy costs with a relatively warm winter. China's economic reopening appears on track as it transitions from strict pandemic lockdowns, though long-term challenges remain. We think investors have appropriately priced in the somewhat more resilient economic picture in developed markets. With that in mind, we are equal weight developed market equities in our global policy model, which guides asset allocation for Northern Trust portfolios. We are underweight investment-grade bonds and modestly underweight emerging market equities, while overweight high-yield bonds and modestly overweight cash.